Silver ripped from the mid-80s to over $110 overnight. Not a gradual climb, a violent snap. Headlines are blaming tariff threats and dollar weakness. That explanation is incomplete. If you are holding physical, stacking regularly, or trading around metal exposure, this move was not just about price. It was a structural tell. Most viewers will chase the headline. You are here right now, which means you are early to the real story. There is one signal flashing that preceded every violent metal move of the last decade. Almost nobody is watching it. I am going to show you what actually broke, teach you the two patterns that repeat across every stress cycle, and give you the exact watch list we are using this week. Not telling you what to buy, showing you what to watch. Let us build. Before we go further, subscribe if you have not already. We are building a place for people who watch flows, not narratives. Comment watching if you caught this move live. Now, let us slow down the tape. Silver was trading in the mid-80s just days ago. Tariff headlines hit. Dollar index started slipping. Safe haven bid kicked in. But here is the part most coverage is missing. Supply was already tight. Lease rates had been creeping higher for weeks before the move. Dealers were quietly increasing premiums. Exchange inventories were sliding, while open interest stayed elevated. And here is where it gets uncomfortable. The market did not move because of demand. It moved because of stress. Think about that. Demand creates gradual trends. Stress creates dislocations. This was a dislocation. We have seen this pattern before. It has a name, a rhythm, and a tell. Your job is not to predict the next move. Your job is to understand the mechanics so you can interpret what you are seeing in real time. That is the difference between reacting emotionally and responding strategically. Let me show you the first mechanism. We call this the pressure valve pattern. Here is how it works. Physical silver is a sealed pipe. Paper silver is the gauge on the outside. When the gauge stays calm, but the pipe keeps filling, pressure builds invisibly. Eventually, the valve blows. That is what just happened. Let me walk you through the setup. Financial markets price silver based on futures, options, and ETFs. Those instruments are liquid, leveraged, and heavily traded. They dominate price discovery. But physical silver moves differently. It is mined, refined, fabricated, delivered, and stored. It has real constraints. When financial positioning skews one direction and physical constraints tighten the other, the two markets start to decouple. The gauge says everything is fine. The pipe is filling. Most participants watch the gauge. We watch the pipe. Over the last few months, here is what the pipe looked like. COMEX registered inventories drifted lower. ETF inflows stayed steady. Industrial demand remained firm. Retail buying accelerated quietly. Meanwhile, futures positioning was skewed short. Open interest stayed elevated. Lease rates, which measure the cost to borrow physical metal, started ticking up. That is the tell. Lease rates do not move on speculation. They move on stress. When someone needs physical metal and cannot get it easily, they pay more to borrow it. That cost shows up as a rising lease rate. It is one of the most ignored signals in the entire commodity complex. Circle this. The last 3 times lease rates spiked before a major move. The second move was larger than the first. Not a guarantee, a pattern. So, tariff headlines hit, the dollar weakened, and safe haven flows turned toward metals. Normally, that would create a steady bid. Instead, it created a violent spike. Why? Because the system was already under pressure. The valve was already straining. The headline was just the trigger. The real force was structural. Now, here is why this repeats. Financial models consistently underweight physical constraints. They assume liquidity is infinite. They assume delivery is frictionless. They assume inventory drawdowns are temporary. Most of the time, those assumptions hold. But when they break fast. And the break tends to overshoot because the market spent weeks or months ignoring the build. This is not unique to silver. We have seen it in palladium, nickel, natural gas, and lumber. Any market where financial instruments dominate price discovery, but physical constraints bind supply, will eventually show this pattern. The pressure valve pattern. Invisible build, sudden release, overshoot. If you think $110 was the top, wait until you see what happens when the pressure builds again. Not predicting that it will, showing you the mechanism so you recognize it if it does. Let me show you the second layer. This one is quieter but more dangerous. We call it the rationing loop. Here is how it works. As price rises, availability starts to worsen. Wholesalers pull back. Dealers stretch delivery times. Buyers accelerate purchases not for price, but for access. The market shifts from price discovery to availability panic. That feedback loop repeats until something forces it to stop. Let me make this concrete. Imagine you are an industrial user. You fabricate solar panels, electronics, or medical devices. You need a steady supply of silver every quarter. Normally, you call your supplier, lock a price, and take delivery in 2 weeks. Now, imagine premiums start rising. Your supplier says delivery might take 4 weeks. You call around. Everyone else is quoting longer windows and higher premiums. What do? You do not wait. You lock supply now, even at a higher price, because your production line cannot afford a gap. That decision makes sense for you. But when dozens of industrial users make that same decision at the same time, it drains spot liquidity faster than the market can refill it. Wholesalers see the draw and raise premiums again. Delivery windows stretch further. Retail buyers notice and start stacking harder. Traders see the move and pile in. Each wave reinforces the next. This is the rationing loop. It does not require a supply shock. It just requires the perception that supply might tighten. Once that perception takes hold, behavior changes. And behavior change accelerates the very tightening everyone feared. We have seen this loop play out in previous cycles. In 2011, premiums exploded. Dealers were quoting 4 to 6 week delays on common products. Buyers were prepaying to secure future inventory. The market was not pricing silver, it was pricing access. That is a very different game. Right now, we are watching for early signs of the loop restarting. Premiums are elevated but not explosive. Delivery times are stretching but not breaking. The question is whether this stabilizes or accelerates. If industrial users begin locking supply on longer terms, that will drain liquidity from the spot market. If dealers start limiting order sizes or requiring deposits, that is a signal the loop is tightening. If ETFs see sustained inflows while registered inventories keep falling, the pipe is still filling. Not saying any of those will happen. Saying those are the markers we watch to gauge whether the loop is engaging. Can it reverse? Absolutely. Price could consolidate here. Dollar could rally. Tariff fears could fade. Physical premiums could compress. The loop could stop. But if it does not stop, here is what happens next. The market splits into 2 tiers. Financial silver, traded on screens, stays liquid but disconnected. Physical silver, moved in trucks and vaults, becomes scarce and expensive. The spread between the two widens. Arbitrage breaks down because delivery is constrained. And at that point, price discovery stops being about supply and demand. It becomes about who can actually deliver. That is the part nobody likes to admit. Markets assume fungibility. They assume 1 ounce of silver is the same as another. But when logistics freeze, geography matters. When vaults are empty, proximity matters. When delivery windows double, timing matters. The commodity becomes a network, and networks do not price efficiently. They price based on access. Think about that. Your job is not to know if this will happen. Your job is to understand what it looks like if it does. So you are not blindsided. So you can interpret the signals instead of chasing the headlines. Let me give you the watch list. Before we do, here is what you need to sit with. Most people are asking the wrong question. They are asking how high silver can go. The real question is how thin is the market really? Price is an output. Structure is the input. If structure is stable, price will oscillate and mean revert. If structure is stressed, price will dislocate and overshoot. Right now, we are watching one specific indicator that just crossed a threshold we have only seen 3 times in the last decade. Each time, the move that followed was larger and faster than the initial spike. I am going to tell you what it is. But first, let me show you the 3 paths forward and what to watch this week. Here are the scenarios we are tracking. Path 1, stabilization. Tariff headlines de-escalate. Dollar index rebounds. Safe haven flows reverse. Silver consolidates in the low to mid-90s. Premiums compress. Lease rates normalize. Delivery windows shrink. This is the soft landing. It requires macro headwinds to ease and physical stress to release. Possible, but not certain. Path 2. Grind higher. Tariff uncertainty persists. Dollar stays soft. Physical premiums remain elevated. Inventories drift lower. Industrial users start locking longer-term supply. Silver stair-steps upward in a choppy grinding move. No panic, but no relief either. This is the slow squeeze. It favors patient holders and punishes late chasers. Path 3. Stress escalation. Delivery issues surface. Lease rates spike. Premiums widen aggressively. Registered inventories draw sharply. Volatility expands. The rationing loop engages. Silver moves violently in both directions as financial and physical markets decouple. This is the chaos scenario. It rewards those who understand structure and destroys those who trade on emotion. We cannot know which path unfolds. We can only watch the signals and adjust. Here is what we are tracking this week. Signal 1. Silver lease rates. Normal range is near 0 or slightly negative. Stress shows up as a sustained move above 1%. Panic shows up above 3%. We are watching for multi-day spikes, not single-day noise. A rising lease rate means someone needs physical metal and is willing to pay to borrow it. That is information. Signal 2. Physical premiums versus spot. Retail premiums on common products like Eagles or Maples normally run $2 to $4 over spot. Wholesale premiums on 1,000-ounce bars run 30 to 60 cents. Right now, retail premiums are elevated. We are watching whether they widen further or compress. If wholesale premiums start climbing, that tells us stress is moving upstream. That is the earlier signal. Signal 3. COMEX registered inventories. Registered silver is metal available for delivery against futures contracts. It has been trending lower for months. We are watching the rate of draw. A steady decline is background. A sharp multi-week drop is a red flag. If registered inventories fall while open interest stays elevated, the risk of delivery stress increases. Not a certainty, but a marker. Signal 4. Dollar index reaction to tariff headlines. Silver moved inversely to the dollar during this spike. If the dollar stabilizes or rallies, that removes one tailwind. If the dollar continues weakening, the safe haven bid stays in play. We are watching DXY around the 100 to 102 zone. A break below 100 could extend metal momentum. A rally above 103 could stall it. Signal 5. Gold-silver ratio compression speed. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. It was above 90 recently. It compressed sharply during the spike. Fast compression suggests silver is in a momentum regime. Slow compression or reversal suggests the move is fading. We are watching whether the ratio holds below 75 or drifts back higher. These are not predictions. They are interpretation tools. Your job is to track them, understand what each shift means, and adjust your approach accordingly. Now, the risk cluster. If you are trading around this, respect the volatility. Position sizing matters more than entry price when a market can move 10 or 15% overnight. If you are holding physical, accept that pullbacks will happen. Stress moves do not go straight up, they chop violently. If you are new to metals, do not chase the spike. Understand the structure first, build gradually. Overexposure in a volatile regime leads to emotional decisions. If you are watching from the sidelines, this is a learning opportunity. Study the mechanisms. Track the signals. Build pattern recognition so you are ready for the next setup. And remember, narratives lag. By the time the mainstream catches a move, the structure has already shifted. We watch flows. We watch constraints. We watch the ignored signals that flash before the headlines arrive. That is what puts you ahead. Not prediction. Preparation. Here is the indicator I mentioned earlier, the one that just crossed a threshold. Silver lease rates spiked above 2% during the move. That has only happened 3 times in the last decade, outside of March 2020. Each time, the initial spike was followed by a larger secondary move within weeks. Not a guarantee it happens again, but a pattern worth knowing. The last time we saw sustained lease rate elevation, palladium went from 1,400 to over 3,000 in less than a year. Different metal, same mechanism. Physical stress forcing financial repricing. Could this reverse tomorrow? Yes. Could lease rates normalize and the whole thing fade? Absolutely. But if they stay elevated or spike again, you will know what it means. You will know the pipe is still filling. You will know the valve might blow again. And you will not be caught off guard. That is the goal, not to predict every move, to understand the structure so you can navigate whatever comes next. If you are tracking flows instead of headlines, you put yourself in the group that sees moves forming instead of chasing them. If you stay disciplined, size positions carefully, and respect volatility, you survive the chaos that shakes out everyone else. This community is built for that, for people who want to understand markets, not just react to them. Subscribe if you have not. Drop a comment. Are premiums rising where you are? Tell us what you are seeing locally. That is real information. And share a moment when seeing a pattern early helped you stay calm during a wild move. We learn from each other. Final thought. Price is the echo. Structure is the signal. The echo is loud. The signal is quiet. Most people chase the echo. We watch the signal. That is the edge. Links are below. Stay sharp. We will see you in the next one.